Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review, and I'm recording this late Friday, a little closer to noon here on Friday, February 24th. So, third week of the market's pullback here, if that's what you want to call it, and it's getting uglier and uglier. This week, depending on what index you're looking at this point, we're down maybe 3.5%, maybe 4% in some indexes on this holiday shortened week. And of course, we're seeing these worse than expected inflation reports, and people are ratcheting up their Fed rate expectations and all that sort of thing. So where does the evidence stand? So clearly we took a lot of definitive steps forward in late December and really all through January in terms of the market. And now we're kind of obviously reversing that. We're sort of in a little bit of an in-between phase. I'm not somebody to look at stuff like this going on and just say, don't worry about it. To me, I tend to ride the bucking bronco, in small measured steps. At the same time, I see a lot of stocks, sectors, indexes, and indicators that are kind of leaning on the fence in terms of, intermediate term okay, intermediate term not so okay. And a few have broken through, but a lot of them are kind of, right there, So I think it's one of these situations where if you took, a few steps forward, obviously in January, yeah, take a step or two back here. Unless you have five stocks and they all look perfect, chances are you bought something near the top, or something's gone up 10% and now they're back down to break even or a little bit of a loss or something like that, where you can pare back a little bit, prune back maybe a stock or two or half of a couple stocks, whatever you want to do. Okay. But at that same time, I haven't seen, like I said, that sort of Katie bar the door moment like we saw a couple of times last year where there's always the chance the market could have this one huge shakeout, but you kind of saw the Fed jawbone and the market just got destroyed, stocks got destroyed, and it was like, okay, sell, turn defensive, and hold a ton of cash. We really haven't seen that here. Again, among a lot of indexes, stocks, sectors, they're kind of leaning on it, but haven't quite broken. So I'd respect what's going on here. But unless you're, on margin or have, 10 terrible stocks or something like that, I wouldn't really be selling wholesale quite yet. Okay. In Cabot Growth Investors model portfolio, we haven't done anything yet. We're still, of course, we still have 35% cash. We never, got super invested. We'll see how the rest of today goes. Maybe Monday. I wouldn't, if things don't firm up, we probably would be doing what I'm talking about, paring back, taking a couple half positions off or selling half of a couple things. We'll see how it goes. But that's kind of my main message now. Obviously, if things continue to worsen, you're going to be building more and more cash as things come down. But if I do still think if the market can find support, and of course that's a big if, but if it does, and we see some upside power, it's very news driven out there. If we see some good quote news, good news drive the market higher, I still think there's a lot of stocks that could be pretty decent buy opportunities going forward. But I have to respect what's going on here. So a little bit better than safe to sorry now, and we'll see what happens here going into next week. Okay, let's hop into the charts. We'll stick with MarketSmith this week. It's a product of Investors Business Daily. You can learn more at marketsmith.com. Great product for individual investors. So this is kind of what I'm talking about here in the market. This is the NASDAQ. And the first thing I just want to say before I get into, I'm going to spend 99% of the time on right now, but if we do break here, I'm not trying to make excuses for the market. If we do break, we're going to raise, I'll raise cash. I think me, I'll raise cash. But we're still in this sort of, we've had this multi-month bottom process. That's the NASDAQ. This is the spiders. And well, it's easier to see on the daily chart, really. Just a multi-month bottoming process in here. So, maybe we come all the way down. It's a whole new leg of a bear market. Anything's possible, but I still just think you add in the huge pessimism, the fact that the Fed is already done, I think by anyone's estimate, most of their tightening. I mean, who knows if it's one rate hike left or three or four, but I don't think they're going to raise rates another 5%. It's one of these things where I still think if the market doesn't hold here and this rally doesn't work, it still could be this prolonged bottoming process. So just sort of a big picture thought right there. But even right now, intermediate term, again, you have sort of the NASDAQ having this run up here, and now it's pulled back to here. Is it tedious? Yes. Is it doing some damage? Yes. Should you respect it? Yes. Has it broken the 50-day line or really, support in here quite yet? Not really. We'll see. Again, we'll kind of see how today, early next week goes. But it's the same sort of thing. If you look at IWM, this is small cap stocks. Same sort of thing. Big bottoming process, big rally here, and now I'm just kind of connecting the closing points here. A pullback. I'm not saying it's all perfect or anything, but above the 50-day line, kind of into an area of support. Mid caps, MDY, pretty similar to the small caps. Again, kind of in an area of support above the 50-day line. So on an intermediate term basis, our indicators, the Cabot Tide, still positive. Now, if you do look at the S&P 500, that's a little bit weaker here. You can see it's dipping below the 50-day line here. The New York Composite, which actually was kind of the strongest index back during that sort of December, October, November rally, it didn't really work. This one's the weakest now. You can see it's kind of been below the 50-day line here for a few days. So, it's a mixed bag, but we're seeing more, again, slightly more good than bad on an intermediate term basis. And even back to the S&P 500 here and some of these other indexes, they're still, it's kind of more neutral than positive or negative, but they're kind of back toward longer term moving averages, and other indexes are living above them. So again, it's not like this definitive, like back here, this was this summer rally last summer. You can see, a huge gap down, doesn't look that big now because of what happened after. And then another huge follow on day a few days later. That was kind of like, maybe this bounce would have worked right here, but chances are we had further to go. And sure enough, the market just kept gapping down and had just a huge decline. We're not really seeing that. Again, something like this. This was back in the March-April rally in 2022. Not to just keep, but again, you just had a couple of sort of definitive huge days. Now, maybe we see that today. Maybe we melt down this afternoon and whatever, but we're not really seeing that. So I would respect it. I think paring back makes sense if you've, assuming you kind of bought some stuff in January. I think there's definitely room to pare back. I wouldn't at this point, just based on the evidence, go wholesale selling. And let's just see. I mean, I know everyone just thinks we're just going to keep melting down, and maybe we do. But a lot of bad news has been discounted here the last 3 weeks, so, we'll see how it goes, all right? The other thing that just, and again, I'm not trying to make this, I don't want to come on here and sound like I'm whistling past a graveyard. Oh, don't worry about it and be some permeable. I think everyone knows I'm not. But interestingly, again, we're not seeing a rush into, this is XLP. Don't get me wrong, it's not falling quite as hard as the other indexes. So on a relative basis, you can see it's kind of perking up a little bit. But it's certainly not, it's not this like leading the way higher, or you can't see it on the chart, but take my word for it, like in the last March and April of 2022, it was very resilient and looked pretty good. So it's actually still kind of trading along with the market, doesn't look so hot. XLU, this is a little bit more interest rate sensitive, but this is hitting this is utilities. This is hitting its lowest level since early November, ballpark. Okay, so, again, it's falling less than the indexes here the last 2 or 3 weeks, but there's not some rush into defensive stocks. The real issue is just, this is, I'm not trading on this, but it doesn't take a genius to see, this is the 5-year note yield, so 45 is like 4.5% on this chart. It doesn't take a genius to see this is mid-October into kind of the end of January. And then since the end of January, this thing's gone up from 3.5 to call it 425. So, or 420 or whatever it is. So, again, you have a lot of sort of negative stuff, headwinds kind of hitting the market here, and the market has responded, but it hasn't quite, really melted down or anything. So we'll see how it goes with interest rates and all that. What I'm seeing more, like I said, with the indexes is a lot of stuff like this, where this is the XLF, not dynamic on the upside here, but pulling back, and it's kind of like, it doesn't look good, doesn't look great, but it's just kind of sitting near the 50-day line, and it's just kind of in this, you wouldn't say it's great, but you wouldn't say like, oh man, it's starting this massive new downtrend here. It doesn't look like back here, look at this drop back here, or some of these drops back last year. It looks much more, I don't want to say calm and collected, but much more orderly anyway, okay? And meanwhile, just before we get into stocks on the sector front, I still see growth stocks they've been a mixed bag. They've been, more good than bad, but they never really kicked super into gear. One of the more encouraging things has been chip stocks, which individual names can be tricky, but as a growth sector, it's a good tell, so to speak. And again, you're just seeing, a pullback here, but again, well above the 50-day moving average, kind of above these December highs so far. NVIDIA helped this week, but there's a lot of other names that look pretty good. So I'm still seeing some growthy areas. Again, I don't want to overstate it, but they look okay. I'm not seeing a rush in defensive stuff. So we're not seeing sort of the red light out there. I think what I'm trying to say is we're seeing kind of some of these flashing yellow lights. So I'd respond to that, but then just take it from there, okay? Individual stocks. Now on that chip stock theme, I might as well mention before I, just to mention NVIDIA, I will say we've seen a lot of these earnings moves, not surprisingly, in the last week or 2 or 3. they pop and then they immediately give up the ghost, kind of like last year or, when they were selling on strength. So I'm not recommending NVIDIA or anything, but I will say, it's been pretty, most of these old leaders kind of do this, they bounce and they kind of die. It's pretty impressive here. I mean, it's working on, I don't know what this is, 8 weeks up in a row here in blue. You've seen some really good volume. You have good earnings estimates here for the next couple of years. So maybe the story's still intact, and that would certainly be, I would prefer a fresher name, which I'll give you a couple, but it would certainly be a positive kind of for the overall market, okay? The other ones that I have mentioned before, this is Allegiant, ALGM. I'm just continually impressed. Now, these things can obviously come in and the market gets ugly and they finally fall 5 or 6% in a day. But ALGM, I mean, just, really this kind of classic IPO base breakout. You see this a lot in, not that this is going to be Facebook, but Facebook, a lot of the big winners did it. I think Baidu, Alibaba, I think, LinkedIn, I remember. Just these big kind of 1 or 2 year bases that form during periods in the market. Gets going, really no ability to pull back so far. ACLS is kind of the same thing, not as new, but same thing on the chip side where you had this big long base, nice tightness, and I mentioned this, really just ramped up. And so far, I mean, it's actually flat this week, it looks like. You can just see it's just very well contained above the 25-day line. So to me, those look like a couple of interesting leaders, okay? On the sort of NVIDIA front, I did want to mention this. This is Tesla. It's not really for me, but I try to stay unbiased about this stuff because who knows, the stock's been up 10 million %. So my guess is it's not going to do great, but I have had a couple questions on it. And I still think old leaders tend not to be great performers, but I will say that it got destroyed. And the volume and the many weeks up in a row has been kind of impressive here. And so far the stock is holding in pretty well. Now it's below its 200-day line. There's all sorts of resistance up here. So it's not for me, but it's one of these names that maybe every week or two I'll kind of keep a distant eye on, because say the market does break and we come in, but this stock holds in here pretty well, like it has so far, well above the 25-day line. Maybe there is something there. Now, no projected earnings growth this year, not my favorite thing. Again, I'm just kind of flagging it based on the volume and the size of the comeback, not just doubling off its lows, because a lot of stocks can fall 95% and double or whatever, but just the fact that it's kind of made up all this ground on even bigger volume, reacted well to earnings, and is holding up well during this market's really its first real test here of this, of the 2023 up move, so to speak. Okay, so just something to keep an eye on. Sarepta Pharmaceuticals, SRPT. I've mentioned this a couple times. They do have earnings next Tuesday. So, but you kind of have this, you had this rush. You can see it was a nothing burger for years. You had this rush higher. Now you kind of have this base on a base. Biotechs have been very iffy, not terrible, but just sort of here and there. But the stock has really not done anything wrong. It's just kind of held in there. And it would be interesting. It's got great sales growth, no earnings yet, but new products. And, let's see if it can react well to earnings. Maybe it does, maybe it doesn't, but just something to keep an eye on. Sort of back in the cyclical vein, this is Autoliv, truck equipment, stuff like that. Still has overhead here, not a super dynamic performer, but you can kind of see a lot of these things. You can just see on the daily chart, up, down, just like kids scribbling on a piece of paper. But then again, you're always looking for a change in character. So here's your earnings gap, and just very tight and controlled in here above the 25-day line, even as the market pulls in. And frankly, a lot of cyclical stocks pull in, okay? On that note, Terex, TEX, this is more in the construction phase. I wouldn't say it's near a good buy point. I wouldn't be chasing stuff. But again, you kind of had this long, tedious bear market. You had the post-pandemic run, the bear market, bottomed out for a while, and now it's just kind of, you can just kind of see how it thrusts higher here. Nice big volume, pulls back pretty well, controlled in here. Now it's thrusting higher here, many weeks in a row of big volume. Not the thickest name. It's kind of a small cap name, $4 billion market cap. But just something to keep an eye on. There's a couple other names in that group that look pretty good. Steel Dynamics, a little bit of an ugly week here. It's down. It's actually down, let's see, 6-7% as I record this. But you can see overall just kind of still on the weekly chart in an uptrend, holding above the 50-day line. No volume. Look at this volume this week. It looks like it's going to be one of the lowest volume weeks in a long time, which I think is a good thing given everything. So, if you want to take a swing at it or keep an eye on it, just something to think about in that group. Oil services, it's funny. Love-hate on my end with oil. I just see a lot of every time I see a couple of good oil service stocks, I'll see one break, but then I'll see another one gap up, and then I'll see another one break. So it's one of these where it's a very mixed group. There's a lot of cross currents there, but FTI is one. It has been in an uptrend for a while. It's a little lower price, but you can see reacted well to earnings, and kind of after a 10-week line test here. And this is a really just, we used to love these sort of relative performance lines where they're very not just going up, but persistent, sort of, up 3 weeks, down a week, up 3 weeks, down. Can only pull back for a week or two or underperform for a week or two. So that looks good. And I will say Weatherford, we took our profit. We had a pretty good profit here in top 10. So we did sell it, but I will just say, this is British. They came out of bankruptcy. Again, it's had a big run here. So I lean toward it needing some time. But the numbers are huge, like way, way above estimates. $4 this year. I think it used, just before earnings, they thought it was going to be $3 this year. And just acting well. Again, you can see the ramp here on earnings. So my guess is it will digest. Some of these will digest, but there's still some strength out there in oil service names. Super Micro. This is another one I go back and forth on. Couple reasons. One, it's super crazy, like 5% a day. Number two, it's I don't want to say it's had this huge, massive run, but it's been in the news, and it's very wild and woolly here. You can call this kind of a sloppy third stage base, or if that's your game or whatever. What I am noticing is just a lot of relative strength, gigantic sales and earnings growth. This year's estimates, I guess they're going to flatten out, but this is one of these things where who knows? They always think these things are going to flatten out, and then they end up being much higher. But $10 of earnings this year. And it's just hard not to notice the strength. Now, the stock went from 98 to 86, now to 96, within a few days. So good luck with that. You'd like to see it settle down, but it's just something I am keeping a distant eye on. It's been on and off my watch list. If the stock could settle down and obviously the market hang in there, it would be kind of interesting, okay? Aerospace still looks good. There's a lot of names in there. Actually, interestingly, today, Boeing, I think it had some bad news, and Boeing, not so good. Listen, big picture, I wouldn't say it's, this thing's heading down here or anything, but intermediate term, break of the gap below the 50-day line, never something you like to see. That said, something like Hexcel, this was in top 10 this week, HXL, carbon fiber, stuff like that. Again, not dynamic, but kind of coming out of this very long-term range, very good volume down here. Excellent earnings estimates here, 45% this year, 34% next. Not cheap stock in terms of valuation, but looks pretty good. Howmet, again, HWM, not dynamic, but kind of slowly kind of coming out of these zones. You can see here on the daily chart, nice move on earnings, kind of pulling back maybe to a good entry point. That's up to you. Transdigm, TDG, this is for those who love $700 stocks, which is fine. Just buy fewer shares. But again, kind of coming out of these long-term ranges, you're getting some volume accumulation. You have good earnings estimates. Good sponsorship. I mean, this one has 1,200 funds and all that sort of thing. So TDG looks pretty good. So aerospace is still kind of a port in the storm, and just kind of a nice little pullback here to the 25-day line. I wanted to flag First Solar, kind of like Sarepta. First Solar, again, earnings next Tuesday, FSLR. Kind of what's known as, you can call it an ascending base, sort of 3 pullbacks in here, or like a base on a base on a base, whatever you want to call it. But kind of out to, I think this is all-time highs. Let's take a look. No, not all-time highs, but out to many, 10-year highs or whatever, and just kind of stair-stepping its way higher. And possibly 3 weeks tight here, if that's your thing. We'll see how it closes this week. The group, my big rub is the group is not so good. So this is kind of a lone ranger, but I'm just flagging it because if it does kind of react well to earnings and the market hangs in there, I wouldn't be surprised if it has another run. Hyatt has been a little sloppy, but it's a new relative performance peak today. I like to screen for up on volume every day or every couple of days at least. And those stocks hitting new relative performance peaks to the market just kind of keeps you in gear with what is working and what's not. So you can kind of see relative to the S&P 500 a new high here. A little sloppy after earnings, but only down to the 25-day line. I still see a lot of travel stocks looking good. Couple more names. Procore. This is a cloud software stock, which obviously is not where the strength is, but it's involved in building. And again, you kind of have this bottoming process or whatever you want to call it, double bottom base, blah, blah, blah. But either way, smoke up a chimney here since the calendar flip. Nice reaction to earnings. And actually impressively, not to read too much into a couple of days, but this was the earnings day. I think this was last week. Yeah, this was last Friday. And we've seen a lot gap up and, like I said, come back down pretty sharply this week. This one held up and is actually sort of, new closing highs here, multi-month closing highs yesterday before pulling back today. So just kind of an early sign that, hey, maybe the stock is still under accumulation, which would make sense. It's a newer name and all that sort of thing. Good story. And last but not least, this is kind of in the Sarepta and First Solar bucket. This is AXON. Again, I think I've mentioned this, just kind of a 2-year structure, tightened up here, had a convertible offering, had this big shakeout a couple weeks ago, but closed firm. Again, it has earnings on. I guess everyone's reporting next Tuesday for some reason, but just kind of hanging in there. I mean, not really doing anything, but over the last 3 weeks, that's been pretty good. Again, earnings next Tuesday, new RP peak. I don't know. We'll see what happens on earnings. It's a little bit of a thinner trader. Maybe it pops, comes back in, but overall a nice setup. Okay. So back to the market. Again, I'm not trying to make it sound all perfect, but I think overall we've had about a 7.5% correction on the NASDAQ here after this accelerated ramp. And I think there's been enough evidence degradation to do some trimming. If you have been doing, obviously if you're 90% cash, you don't have to, but if you did some buying, I think it makes sense to do some trimming. That said, if you have some things that look good, if you have some things that have kind of tediously pulled back, but they're still into the 50-day line, I wouldn't be in a rush to just sell wholesale. I would give things a little bit of a chance. Tight leash, I would definitely have a plan in case things do continue lower. But at the end of the day, things like new lows aren't a disaster. The intermediate term trend, not a disaster. Even the longer term trend, not a disaster. And the fact that the market has pulled in tediously but not imploded while rate hike expectations go up, not the worst thing. So, slightly more negative, or I guess more cautious than I was the last week or two, just based on the action, but really more curious to see what we do here, as a lot of things have moved into support. Okay, that's all the time I have for today. As always, thanks for listening, and come by again next week for another Cabot Weekly Review.